Do you think you can invest in almost anything you want with a self-directed retirement account without any IRS implications? Well, you're almost right. There are very, very important tax and IRS rules and regulations that you will need to know in order to keep your self-directed retirement account in full IRS compliance. The good news is they're not super complex. However, if you do violate the rules, it could cause a major tax problem for you and potentially disqualify your retirement account. So you don't want to go there. There's one surprising rule that even the most sophisticated investors are not well versed in, and I'm going to address it in today's video. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial. And on today's video, I'm going to review everything you're going to need to know about IRS rules and regulations involving prohibited transactions, disqualified persons, yubit, tax filings, ongoing administration and compliance, and much, much more. So let's get started. The most important rule to know before and when engaging in a self-directed retirement account are the prohibited transaction rules. Good news is they're not that complex. They're basically just common sense, right? The intent behind the prohibited transaction rules are as follows. The IRS wants to protect their tax distribution environment. They need to make sure that if you do pull money out of your retirement account, you're going to pay tax. That is a revenue generating exercise for the government, and they need to protect it. So if they just let everyone just pull money out of their IRA and invest with their kids or their spouse, the IRS in no way is going to be able to capture those funds and generate tax revenue from distributions. So the core intent of these rules is to say, listen, if you're going to do anything with your retirement account that's going to personally benefit you, your lineal descendants, your parents, your children, your spouse, daughter-in-law, son-in-law, or any entities 50% or more controlled by such persons, you can't do it, right? Because if I could just give all my IRA money to my wife and circumvent the distribution rules, of course I'm going to do it. And this way, the IRS would lose all that potential tax revenue. So they're saying, listen, if you want to invest with your disqualified person, which I will expand on momentarily, then please pay the tax, and then you can use the money for anything you want. There's two other things you can't do, and those are found under Section 408. They're not really prohibited transactions. They're more just not permitted investments. And those are life insurance and collectibles like art. But here's some exceptions to the disqualified person rules. Brothers, sisters, aunts, uncles, cousins, stepchildren. Those are not deemed disqualified persons. Potentially entities you own less than 50%. Maybe you own a company 10% or 30%. There are potential ways to make IRA investments with those parties and not trigger the prohibited transaction rules. Unrelated business income tax. And here is my secret tax pitfall that I mentioned earlier in this video that a lot of sophisticated investors have never even heard of. In fact, a lot of accountants have never even heard of yubit. Why? Because it's a tax that's really only triggered for charities, like the Red Cross, and retirement accounts. Why? They're both treated as 501 trusts. So for most investors that are sophisticated but aren't really doing alternative assets in the retirement account world, or accountants not dealing with tax exempts, they're never going to really get into any type of contact with the yubit rules. But yubit could become a very big tax problem for your retirement account. It's only triggered in 3 instances. That's the good news. In most cases, all passive investment income from an IRA, like capital gains, interest, dividends, royalties, rental income, is exempt from taxation. Thank God, right? But here are 3 ways yubit can get triggered. Use a non-recourse loan to buy real estate. Use a non-recourse margin loan. And why do I say non-recourse? Is because the prohibited transaction rules that I previously mentioned do not allow a disqualified person, me, to personally guarantee an obligation on my retirement account. So that is why the loan must be non-recourse. The third way to trigger yubit is if an IRA or 401k invests in an active business like a restaurant through a pass-through entity like an LLC. Obviously, if your IRA invests in a corporation like Tesla or Apple or 99% of all the publicly traded companies out there, there's no yubit tax since the C Corp blocks the application of the yubit. But if your IRA invests in an LLC, you could trigger yubit. Okay, so it's only in those three instances. The yubit tax gets triggered at approximately a $15,000 net income threshold, and the tax rate can go as high as 37%. So it's a pretty spiteful tax, but the good news is there are ways to minimize it and even ways to get around it if you work with the right people. Required reporting compliance, the great news is you don't have to do much. If you work with IRA Financial, we handle everything from 5498s, which is the annual IRA information return, 1099Rs if you make contributions or take distributions. Even if you do a checkbook control structure, we have a tax service where we'll file partnership returns. And even if you do trigger yubit, we'll file the 990T when it's due with the IRS. So we handle it all for you, and we're very unique in that respect as the only company in the space that not only sets up self-directed retirement accounts, we have the expertise to do ongoing consulting service, compliance, and annual custodian and administrative requirements. Now that you know all the key rules and regulations involved in investing with a self-directed retirement account, it's super important that you actually understand what type of investments, what type of assets can a self-directed retirement account invest in and hold. Thanks again for watching. I hope you've learned a lot about all the rules and regulations involved in self-directed retirement investing. Not super complicated, but very, very important to know.